In this video, we continue our discussion of the theory of capital structure. In the previous video, we covered the theory of capital structure with no corporate taxes. In this video, we will cover the theory with corporate taxes. Does debt create value? The responded to this question in their first paper published in 1958 and concluded that debt does not create value provided there are no corporate taxes. So the value of a levered firm will be equal to the value of an unlevered firm. In such a case, an investor will be indifferent to invest in a levered firm or an unlevered firm. If the investor wants to earn the higher return in a levered firm, he or she can create homemade leverage. We know the return on equity in the levered firm will be higher than the return on equity in the unlevered firm. So, to earn the same return from investing in an unlevered firm, the investor can create homemade leverage by borrowing money at the risk-free rate and then using his own equity and the borrowed money and investing it in the shares of the unlevered firm. Thus, this will create a leverage effect of the same magnitude as of investing in the levered firm. In such a case, it would not matter if the investor had invested in a levered firm or the unlevered firm. Because of the homemade leverage, the investor will be able to earn the same higher return on equity in an unlevered firm as would have earned in a levered firm. The absence of corporate taxes in such a case makes capital structure irrelevant. Therefore, concluded that debt does not create value provided there are no corporate taxes. As were criticized for assuming no corporate taxes in their first paper, in their second paper they relaxed this assumption and allowed for corporate taxes. However, they kept all of their other assumptions the same. So here we keep all the assumptions from our first video the same. The only assumption that we are changing is the corporate taxes one. So here we allow that the companies have to pay corporate taxes. In their second paper, they concluded that if there are corporate taxes, then the value of a levered firm will be greater than the value of unlevered firm. And they provided two specific propositions. The first proposition is that the value of the levered firm is equal to the value of unlevered firm plus tax shield. The second proposition is that the cost of levered equity is equal to the cost of unlevered equity plus the cost of unlevered equity minus the cost of debt into 1 minus the tax rate into the value of debt divided by the value of equity. We have an adjustment of 1 minus t factor because we now have assumed that there are corporate taxes. Specifically, the value of levered firm is greater than the value of unlevered firm. So is the cost of levered equity greater than the cost of unlevered equity. We have the same figures for firm U and firm L from our first video, where firm U is the unleveraged firm with zero debt and firm L has 10,000 in debt and 10,000 in equity, and the debt is requiring an interest payment at 12%. So it is a 50% equity and 50% debt finance company. The only difference is that here we are assuming that there are corporate taxes and both the firms have to pay a 40% corporate tax. The earning before interest and taxes are the same, $5,000. However, NOPAT has now dropped from $5,000 to $3,000 for both the firms as there are 40% taxes that needs to be paid. That is $5,000 multiplied into 1 minus 40% tax rate is equal to 3,000. The return on invested capital is 15% for both the firms, so the basic earning power of the companies is the same, which is $3,000 divided by $20,000, that is 15% for firm U as well as firm L. We calculate the net income of the unleveraged firm and the leveraged firm here. The leveraged firm has to pay $1,200 in interest. The unleveraged firm has no debt, so it is paying no interest. The tax rate is 40%. So firm U will have to pay $2,000 as taxes. Firm L has $1,520 in tax expenses, which is $480 less than the taxes of firm U. This is because it is able to save $480 in taxes because interest expense is a tax deductible expense. So the tax savings of the levered company are 1200 multiplied into 40% the tax rate, which is equal to 480. So each year firm L is able to save $480 in taxes because interest is a tax deductible expense. It reduces its tax bill to $1,520. That is why we see firm U has to pay $2,000 in taxes while firm L has to pay only $1,520. So the tax savings per year is $480. The net income of both the companies is not the same this time because of the payment of corporate taxes. So the unleveraged firm has net income equal to $3,000 and the leveraged company has its net income equal to $2,280. The cash flow to the shareholders is $3,000 in the unleveraged firm and $2,280 in the leveraged firm. As per our assumption, all income is paid out as dividend to shareholders, so the dividend payout ratio is 100%. That is, retention ratio is 0. There is no net investment in operating capital, so the growth rate is assumed to be 0. There is no borrowing by the unleveraged firm, so no payment to the creditors in this company. However, the leveraged company has borrowed money, that is $10,000, so it is paying $1,200 as interest. So this is the cash flow to the creditors in firm L. The total cash flow, which will be equal to the free cash flow, is $3,000 for the unleveraged firm and $3,480 for the leveraged firm. Now see here that the difference between the two cash flows is exactly equal to $480, which is the tax savings by firm L from interest payments. So we see from the analysis so far that all other things are constant for both the firms except that one company is borrowing and the other company is not borrowing at all. Again, we start with the calculations of the unlevered equity, which is equal to net income of the unlevered firm divided by the total equity of the unlevered firm. Note, the total equity of the unlevered firm is equal to the total assets of the unlevered firm as it is 100% financed by equity. Also, the free cash flow of the unlevered firm will be equal to the net income of the unlevered firm, which will be equal to the NOPAT of the unlevered firm, which will be equal to the earning before interest and taxes of the unlevered firm multiplied into 1 minus the tax rate. And this all holds because there are no investments in operating capital, and the company has zero growth. Using the figures from the previous slide, the cost of unlevered equity is 15%, which is net income of $3,000 divided by total equity of $20,000, which is also equal to the return on invested capital in the unlevered firm because there is no debt. So the return on equity or the cost of equity will be equal to the return on invested capital. Now, as we have clearly stated here, the free cash flow to the unlevered firm should be equal to the net income of the unlevered firm. The free cash flow for the unlevered firm here is equal to $3,000. And since there is no growth in the company, each year the company will earn $3,000 as free cash flow. Now, to estimate the value of the firm, we have to calculate the present value of all its future cash flows, and for that we need to use the cost of unlevered equity as the discount rate. So it is a perpetuity, and we are estimating the value of the unlevered firm here as the present value of all the future cash flows of the unlevered company divided by its cost of equity, that is $3,000 divided by 15%. So the value of the unlevered firm is equal to $20,000. There is no value added in this company as the market value of the firm is exactly equal to the book value of its capital or total assets. Now, under proposition 1, the value of a levered company should be equal to the value of the unlevered company plus the value of the tax shield. Now, we have estimated the value of unlevered firm to be $20,000 in the previous slide. The value of tax shield is equal to the tax rate multiplied into the total borrowing, that is debt. So firm L has borrowed $10,000. So $10,000 multiplied into the tax rate, which is 40%, that is $4,000. And we already know the value of the unlevered firm to be $20,000. So we can estimate the value of the leveraged firm to be $24,000 from this formula. Alternatively, we can approach this using the free cash flow valuation. So the value of the levered company is equal to the free cash flow to the leveraged company divided by the WACC of the leveraged company, which is equal to the value of the unlevered company, which is the free cash flow of the unleveraged company divided by the cost of unlevered company, plus the tax shield annually divided by the cost of debt. So each year, how much is the tax shield? We estimated this to be $480, and the cost of debt was 12%. So we can do it like this. $3,000 divided by 15%, which gives us $20,000, and then $480 divided by 12%, which gives us $4,000. So 20,000 plus 4,000, 24,000. Alternatively, we can estimate the value of the leveraged firm using this formula. However, for that we need the WACC of the leveraged company, and for the WACC of the leveraged company we need the cost of the equity for the levered company. This representation here is very important as it clearly shows how much value is created by debt. The value created by debt is equal to the present value of the tax shield on interest payment, which is discounted at the cost of debt in this formula. We can also see the relationship like this: KD multiplied into T multiplied into D. KD is the interest rate, T is the tax rate, and D is the amount of borrowing. So if we multiply KD by the amount of borrowing, that is our total interest expenses, which is $1,200. If we multiply that by the tax rate, which is 40%, we get TS, which is the tax savings. And if we divide this by KD, because every year we are going to save this much in tax savings, so if we want to calculate the present value of all our tax savings, divide the tax savings every year by the cost of borrowing. Because KD is here and KD is here, we can see the relationship like this. That is, the present value of the tax shield is equal to the savings in taxes every year divided by the cost of debt. So we look at this TD term here. This is obtained by manipulating these elements here. The KD crosses with KD, and we are left with the tax rate and the amount of borrowing, and which is actually equal to the present value of the future tax shields, and that is discounted at the cost of debt. So this is just another way of looking at it. Note there are two different types of cash flows here. One is the free cash flow to the unlevered equity, which is discounted at the cost of unlevered equity. And the other cash flow is the annual tax savings on interest payment, which is discounted at the cost of debt. This is because it is assumed that annual tax savings are risk-free and therefore should be discounted at the risk-free rate, which is the cost of debt here. On the other hand, these cash flows reflect the business risk of the firm and therefore should be discounted at the unlevered cost of equity, reflecting only the business risk. There is another way of looking at the value of the levered firm, and that is to segregate the value of the levered firm into the value of equity of the levered firm and the value of debt of the levered firm. And for that, we have to divide the cash flow of the levered firm into cash flow to equity and cash flow to the creditors. And we know that the cash flow to the creditors is the interest payment, which in our case here is $1,200, and the cash flow to equity is $2,280. And we already know the cost of debt here to be 12%. However, we cannot use this formula yet because we still don't know the cost of levered equity. However, we know this relationship exists, and later on we will use it to confirm our numbers. We can formally write this relationship as value of the firm is equal to value of equity plus value of debt. As we don't have the cost of levered equity yet, we cannot calculate the WACC of the levered company. So let's focus on calculation of the cost of levered equity and then estimate the WACC of the levered firm. As we know, in proposition 1, we have the value of the levered firm equal to the value of unlevered firm plus the value of the tax shield, which is equal to the present value of all the tax shields on interest payment discounted at the cost of debt. So we have the value of unlevered company calculated equal to 20,000, and the value of the tax shield will be equal to the borrowing amount 10,000 multiplied into 40%, that is the tax rate, which is 4,000, so that is 24,000. Again, we can see this as 12% multiplied into 40% multiplied into 10,000 divided by 12%. So 12% crosses with 12% and we are left with the tax rate and the amount of borrowing. So 40% multiplied by 10,000. As discussed on the previous slide, the value of the levered firm is equal to the value of equity of the levered firm plus the value of debt in the levered firm. So we can estimate the value of equity as the difference between the value of the levered firm minus the value of debt. We have calculated the value of the levered firm to be 24,000 here, and we know that the value of debt is 10,000. We are given this number, and it is assumed that the cost of debt will remain the same, so the market value of debt will be exactly equal to the book value of debt. So 24,000 minus 10,000 gives us 14,000. That is the value of equity, and we are assuming that this is also the market value of equity, and this is the market value of debt, and this is the market value of the firm. In other words, we are assuming the markets to be efficient and perfect in all sense. Now we turn our attention to proposition 2 and calculate the missing cost of levered equity that we need to value the levered firm using the alternative approaches of free cash flow valuation. So the cost of levered equity is given by this mathematical expression. We have all the required inputs, so let's first calculate the weight of debt and the weight of equity, which are market value of debt divided by market value of the firm and market value of equity divided by market value of the firm. Remember, we can use 10,000 and 14,000 here, but I prefer to use the weight because I need them also here. The WACC formula requires us to actually include the 1 minus t element here because there are corporate taxes. We calculate the weight of debt and the weight of equity and then use them in the cost of levered equity formula here to estimate it to be 16.29%. We use then 16.29% in the WACC formula to get the WACC of the levered firm equal to 12.5% approximately. We have the required input and we can go back to proposition 1 and confirm that the value of the levered firm is equal to the value of the unlevered firm plus tax shield using the two alternative valuation approaches. Now to estimate the value of the levered firm, we need the free cash flow to the levered firm and the WACC of the levered firm. We have already estimated the WACC of the levered firm to be 12.5%. The free cash flow to the levered firm are equal to earning before interest and taxes of the levered firm into 1 minus the tax rate, which is equal to no PAT of the levered firm. In our case, the free cash flow to the levered firm are equal to $3,000. $3,000 divided by 12.5% gives us the value of the levered firm equal to $24,000. Though the cash flows here do not reflect the $480 in tax savings, it is adjusted in the WACC formula when we adjust the cost of debt for the tax rate, that is 1 minus 40%. So the WACC here is accounting for the tax savings on the interest payment, and this is why we still get the value equal to $24,000, though we are not accounting for it explicitly in the cash flow. This $24,000 is exactly the same amount as we obtained from adding the value of tax shield to the value of unlevered firm, that is 20,000 plus 4,000, 24,000, and this provides support for proposition 2, as this WACC gives us the same exact value as we obtained from the proposition 1. Hence, it confirms that the cost of levered equity was correctly calculated, and so was the WACC, and that is leading us to have the same value of the levered firm from this model as we obtained from proposition 1, which was value of the levered firm is equal to the value of unlevered firm plus tax shield. So here we just are putting in the values from our numerical example and $3,000 is the free cash flow to the unlevered firm divided by the cost of unlevered equity plus the value of tax shield 480 divided by the cost of debt 12%. So we get 20,000 plus 4,000, 24,000. This is exactly the same amount we obtained when we estimated the value of the levered firm on the previous slide using the free cash flow to the levered firm and the WACC of the levered firm. Hence, we confirm that the value of the levered firm obtained using the WACC of the levered firm is exactly the same as given by this expression. Similarly, we can segregate the value of the levered firm into the value of equity and value of debt. So the value of equity is equal to the free cash flow to the levered firm divided by the cost of equity of the levered firm, and the value of debt is equal to the interest payment to creditors divided by the cost of debt. If we put in the numbers here, 2,280 is the cash flow to the shareholders in the levered firm, and the cost of levered equity we estimated was 16.29%. The interest payments were $1,200 and the cost of debt was 12%. So if we calculate the present value of all the future cash flow to equity, it is $14,000, and if we estimate the present value of all the interest payment in the future, it is $10,000. So the total value of the levered company is equal to 24,000. This time we have segregated the value of the levered firm into the value of equity and the value of debt. So from this example, it is also clear that whatever value is created by borrowing, it goes to the shareholders. The value created from borrowing in this case is 4,000, and we see that shareholders' equity has a book value of 10,000 but a market value or fair value of 14,000. So this 4,000 increase is because of the tax shield on the interest payment on debt. Despite allowing for corporate taxes, are still criticized for their assumptions, particularly the assumption of unlimited borrowing at the risk-free rate, which is internally contradictory because following the theory, it leads to 100% debt financing, as the cost of debt is normally cheaper than the cost of equity. That means that firms will continue substituting debt for equity, which ultimately leads to 100% debt financing, and that is not something realistic. Also, the value of tax shield is calculated using the cost of debt as the discount rate. There are arguments which suggest that the cost of debt should not be used to discount the tax savings on interest payments. These should be discounted at least at the cost of unlevered equity. However, there is no consensus on which rate should be used. Though homemade leverage is one important concept in the theory without corporate taxes, it is not useful in with corporate taxes, as homemade leverage may result in different returns to shareholders of a leveraged company and an unleveraged company when there are corporate taxes.